Hey everybody, welcome to this free edition of our Trader Use Group weekly roundup for the trading week ending February 23rd, 2024. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is power on, but for how long? Well, as you guys probably know, maybe don't know, the markets can generally move a lot further for a lot longer than you've got liquidity to go the other way. So let's take a look a little bit about this past week and just take a look at the charts and see where we're sitting right now and what's up as we go through the end of this month into the month of March. So let me just, if we take a look at this, let's just take a look at how the week did in general. You can see everybody was solid in the green with the exception of the Russell. The Russell's the only one year to date in the red. And if you really look closely, you can see the S&P is actually higher than the Nasdaq. But remember, that's not the Nasdaq 100 futures, which is very strong, which is really generally driven by the AI stocks, right? But the S&P is up 6.69%, Nasdaq up 6.56% year to date. And then, of course, if we go over and look at the forward PE ratio, it's 21.25, but the trailing is 23. So the forward earnings projections are about 7.5% lower than the trailing 7-month or trailing 12 months rather. So let's see how this thing shakes itself out. You can see the earnings yield at 4.73%. The current VIX, it was up for the week, even though most of the markets were up for the week with the exception of the Russell. And the best and worst performers were both in the green this past week. Staples the best, which is a risk-off sector, by the way, a little over 2.05%. Worst energy 0.46, but still in the green. You can see year to date, the best performer is communication services at 9.72, and the worst is real estate, bringing up the rear at 3.34%. Okay. I mean, this whole week in the US pretty much got started and really kicked off when NVIDIA came out with their earnings. Okay. They added a record 277 billion to their market cap. That's the largest ever for any one company after earnings. And the S&P literally moved up over 100 points. Dow up over 400, Nasdaq up over 400, because NVIDIA was kind of viewed by the markets as a go-to company on AI, because a lot of money is flowing into AI, and NVIDIA is the proxy for AI right now. So that's a little bit about what I am seeing here this past week, okay? And then the other thing, we got some data points hitting the markets this past week. We get initial and continuing jobless claims. They came in a little bit below consensus, just slightly above 200,000 new claims for the week. And then we did get the S&P Global PMI data, all right? And we did see manufacturing data surprised most and went up just a little bit to 51.5. It's the highest it's been in 17 months. Kind of helped in part by export orders, right, globally, because this is a global index. And then we did see the PMI on the business activity cooling just a little bit down to 51.3 in January, or in January from 52.5. So we're seeing a little bit of a cooling pullback here, but overall, the markets are still very, very strong in the U.S. In fact, several Fed governors came out this past week speaking about the need for caution and the timing of lowering their rates, right? And what we're seeing is the probability of a rate cut, which was around 80% for March, this March 20th, has which was it was about 80% probability of a rate cut about 6 weeks ago. Now it's moved down to less than 10%. In fact, the rate cut probabilities have moved all the way out to the month of June. Okay. So remember, we get a Fed policy meeting in March. We do not have one in April, then we have one in May. And even in May, the probabilities are under 50% that there will be a rate cut. And then once you get out to June, it moves up over 75% that there will be a rate cut. So all of this hot economic data has really spurred this on. But surprisingly, the tech stocks have shown little fear with rates staying higher for longer, which is a little bit of a change, but a lot of that is due to AI and the revenues coming in and the potential revenues coming in with AI. Should AI falter a little bit, you're going to see the market self-correct very quickly. Okay, so that's a little bit of the risk that's out there right now. And then, of course, if we go over and take a look at the European markets, you can see over in Europe, fairly in the green. The Euro stocks, the CAC 40, and the DAX all solidly in the green for the week. In the green year to date. In fact, the Euro stocks, which are the 50 largest companies across Europe, are doing very well. You can see they're up 7.75%. And if you guys recall, Europe is, if not in a recession, close to being in a recession, yet they're doing very strong because we're starting to see some consolidation and money is coming in with the idea that Europe is going to self-correct and move forward, right? We did get an estimate of the Eurozone composite PMI, and it rose to 48.9. It was 47.9. So in January, it rose to 48.9, which still in contraction territory, but it is an 8-month high. So Europe is slowly starting to see some consolidation. The only ink in this ointment, right, or the mud in clear water right now is the composite PMI for Germany. Their economic output declined for an 8-month in a row, right? And Germany is the economic engine for all of Europe. So as long as they're faltering, it's going to keep downward drag on the rest of the economy there across Europe. And then finally in the UK, the composite PMI there rose 53.3 in February. So that shows a little bit of solid improvement in consumer demand over there in the UK. Okay. Then if we go over to the Asian markets, the Nikkei is on fire like it was last year. Look at the Nikkei. For the week, it was at 1.59%, but look at the year to date, 16.84. It is unbelievable. Unbelievable. And export data came in very strong with Japan, which means they're shipping a lot of stuff to the US and Europe. That's a good thing. Their exports grew just slightly under 12% for the second month of strong growth in a row, right? So that takes away some of the fears of slowing demand. And Japan's trade deficit also shrank to roughly half of what it was a year ago. And the only disappointing thing out of Japan was the manufacturing sector. The latest PMI data showed continuing contraction there, down to 47.2. So like Europe, Japan is probably in a recession. And yet the markets, I mean, just look at them, 16.84%, because the markets are, always making bets on where the markets will be 6 months from now, not where they are right now. And the markets are making the assumption that Japan is going to be consolidating here fairly soon and are moving up. The other thing that gave the equities a boost was the Bank of Japan governor, Ueda. He expressed confidence that moderate inflation was likely to continue as wages grow. And remember what they want to do. They want to be able to get off of all that stimulus that Japan is pumping in there and let the interest rates move up a little bit, which would be very strong, the yen. And we're watching that very closely. And then, of course, if we look at China, a strong week for both. China actually moved into the green first time for the year at 1.01%. Their equities rallied basically because they're just coming off an almost 1 week holiday, the Lunar New Year, and spending really took off. So it does show consumers are starting to spend, or at least they did on this Lunar New Year holiday, right? Tourism revenue over that week-long holiday splurge surged like 47% over last year's. Huge. So consumers were spending, so that helped the Chinese equity market move up. And then on top of that, People's Bank of Japan, they injected, about 500 yen back into their economy. So that, again, with a lot of stimulus. Right now, Japan and China are the only countries that are just really throwing a lot of stimulus money into their economy. The other thing that PBOC did was they announced a 5-year loan prime rate. They lowered it bigger than expected 25 basis points to 3.95%. That's the largest cut that the PBOC has done since 2019. So all of those positive stimulus things really goose their economy. And as you can see, it worked out very well. Now, Hang Seng, they're up also for the week. They kind of follow along with China, although year to date they're in the red, you know. But otherwise, the markets seem very strong right now. Okay, and we're going to have, as I tell our members in our user group, there's going to be a little bit of a pullback, but I do believe the pullback timing and the amount of the pullback is going to be a little bit less than most people had originally planned for at the beginning of this year. What I want to do is I want to move the screen over here. Let me take you over to the E-mini S&P 500 futures. And you're going to see here, it takes about 5 seconds to come up on your screen. You're going to see here that on the 23rd, we hit new highs on the E-mini futures. It was up 6.46%. As you can see here, intraday, and then a little bit of a pullback here. We ended the day down, okay? You could see the almost like a grave top doji here, almost just these types of candles tend to suggest that a little bit of a pullback is going to be in order. Okay, you can see here, if we just zoom out just a little bit, the nature of the MACD. So this big run here that we've seen since about the middle of January is not as strong as the run that we had from November to the end of December. So these are people that didn't participate in that run that are jumping on board, and we'll probably get some more retail traders jumping in. And then I think we're going to have a little bit more of a pullback here. I have been calling for a pullback the last couple of weeks of February, and not because the last couple of weeks of February are two of the worst weeks statistically in the S&P going back 20 years, but they are. But we've had such a strong run that a little bit of a pullback actually will help the markets move higher later on. So I am seeing that. You can see the 50 and the 200 EMAs well expanded away from that. And a typical pullback takes the market back to the 50 EMA. And that would be right around 4874. Let's call it 4900. So to me, you know, a little bit over a 100-point pullback over the next 3 weeks makes sense to me as we lead into the next Fed meeting on March 20th. Okay. And then, of course, if we come over here and look at, just to show you what's really driving everything, if we look at the Magnificent Seven and take a look at their performance for the year, you can see here, let's just get it so you can see it. They're up 17%. It hit an intraday high here and then pulled back and closed below where it moved or opened or closed the prior day. So it was down just a little bit on the day, but you could see here that we made new all-time highs in this, all right, in the Mag 7. So 17%. And then if we look at the FANG index, not quite that kind of performance here. You can see it's 15.62%, right? But I do believe all of these are going to be pulling back here over the next 2 or 3 weeks leading up to the Fed meeting on March 20th. You can see here also we've got no divergence in the MACD here, so that does suggest that any pullback, we still have a lot of dip buyers that are out there, okay? So I can see that very strong. And then, of course, if we come over here and we look at the Russell is the one that's really bringing up the rear. Look at this. It's still in the red. We're below the blue line here, so we're in the red here. It did hit an intraday high, but only up 1.29% on the 15th of Feb. And then it's just languishing. You can see the 50 EMA is holding it up. Should the Russell break the 50 EMA, then I think that'll be a little bit of a break that we're also going to see in the rest of the markets, the other indexes. I think that'll break off from there as well. So these are just some of the things that I'm seeing in this market right here. Now, if we come over and let me just look at the equal weight SPX. If we look at the equal weight, you can see here we did meet new highs this past Friday, but it's only up 2.72%. So the S&P is up over 6.5%, right? But the equal weight is only up 2.72. So we still have that lack of limited breadth. Now, that's not going to be able to go on forever. The markets are always self-correcting over time. The big key is how long can it go like this? Okay. And I do believe it can go for a while, although a little bit of a dip or a pullback to me makes sense. And if we look at the ratio chart of the equal weight over the SPX, you can see here that the SPX is clearly outperforming due to the performance of the Mag 7, right? And then finally, if we look at the Dow, it also is up and made 2024 highs, all-time highs here on Friday before it pulled back as well. But again, the MACD is showing divergence, which is also telling me that we can expect a little bit of a pullback. Although I still believe we're still in a buy the dip on pretty much every pullback that we see right now. Okay. I do see also a larger pullback in price action over 5% sometime in the April-May timeframe. I don't see that before then, unless something comes up that a surprise in the data or a surprise from the Feds on the 20th. But I do see market price action relaxing a little bit leading up to the 20th. Okay, and then of course if we come down here and if we look at Treasuries over here and we look at the bond market, you can see on Friday interest rates moved down a pretty good little bit on Friday. You can see the bonds though, but we're at lows for the year. Bonds have never really, once we kick the year off, it's been moving lower all year long. You can see the MACD, there's no divergence there. That does suggest any move up is going to roll over, which means interest rates, I see higher interest rates leading up to March 20th, right? I mean, that's what the Feds have been saying. And it's just now the markets are starting to cut back on the forecast of how many rate cuts before the end of the year. Okay, I think the markets are suggesting now 4, maybe 5, and the Feds are saying 3. Now remember, this March 20th Fed meeting, we do get the dot plot. They only do that once a quarter. So we're going to get another prognostication going out 12 months of where they see interest rates, and we'll get a good idea between now and the end of the year how many interest rate cuts are the Feds putting in, right? There'll be the 12 voting members, and we'll follow the dot plot and kind of see. That could change the markets and make it much more bearish if they go from 3 to 2 or 2 to 1. The markets don't have that factored in. The markets have factored in 4 rate cuts. So there's still a little bit of a divergence, but we're a little bit closer. But I will point out to you, even given the divergence coming in, with the market expectation of rate cuts versus the Feds, the market's still been able to just move higher on the back of NVIDIA and some of these strong AI earnings and forward guidance companies that we're seeing so far for Q4 earnings. Okay, so that's a good thing. And then, of course, if we look at the 10-year interest rates, obviously the rates this year have done nothing but move higher, right? You can see how the rates, we kicked off the year and we did come down and make a low here on February 2nd, right? And then boom, we just took off. I'm gonna have to change this, but it's February 2nd, and boom, off we went. Okay, so rates are higher so far for this year, and this had no effect on the tech industry, tech sector right now. And of course, if we look at the US dollar with a stronger US economy, the US dollar naturally is stronger, right? You can see here a little bit of a pullback, but this is a buy the dip moment for the US dollar. The 50s over the 200. The dollar's been moving up all year long, just like rates have been moving up all year long with a strong, hot economy. And just as a reminder, the dollar does not move independent of itself. It moves dependent and correlated on the euro, yen, and pound mostly. Those guys are about a little over 80% of the dollar index. The euro is about almost 58% of the dollar index. Yen, a little bit under 14%, and the pound about 12% of the dollar index. So where they move forces the dollar index to move the opposite direction. So with the dollar moving up strong like this, having just a little bit of a pullback, then naturally we would expect the euro to do just the opposite, moving down, right, with a little bit of a move up. So, and that's what we're getting here. And the odds favor of sell the rally in the euro for now. Okay. I do believe the euro through the end of the year is going to end up over in the green. Just right now, they're having some difficulty, as I pointed out, with the economy. And then, of course, if we come down and look at gold, it's just up, down, up, down. It's not really going anywhere right now, right? That's not one that you want to trade, other than some of the trades, some of our members, it's trade is perfectly set up for some of the option trades we do in the gold futures market, are trading GLD. Okay. And then, of course, if we come down and we look at energy, if we look at oil, oil is, you can see here, it made a new high on February 20th, pulled back just a little bit of a divergence there. That does suggest a little bit more of a dip lower. In fact, the Elliott wave count would suggest it's going to come down and make new 2024 lows. I don't see that happening. You could see I had a Elliott wave target down here of in the low 60s. And the only way that's going to happen is if we see signs of a recession, or we get some unknown entity or data point or series of data points that affect oil. I don't see that happening either. So it's going to be one of these kind of things where oil is going to drift a little bit. I don't think it's going to go much higher than where we are right now, unless we get something happening out of Iran, with some of the trouble going on over there, or over in the Russia area, over in that area. So other than that, I just don't see anything happening here. Now, nat gas is a little bit more interesting to me. Look at nat gas. It's come unglued right here. A big part of that was when Sippy Cup Joe announced that they're going to stop a lot of exports in LNG, so that backs up the inventory here. It has nowhere else to go, so you got an inventory overload. But if we just step out in time just a little bit here, right, and go way out, it's even lower than, let me just put it on a weekly, probably a little bit easier to see, so I don't have to crunch it down just a little bit. If we go out on a weekly, and let's just zoom back in a little bit, you can see here on this weekly, we're lower than it hit over here in the early part of 23, and we're coming down to the price level now that was made during the COVID crush, back when everything was shut down, which is why I'm beginning to really like this to the upside, right? And members, we'll go through this in our session Sunday evening, but I do like that to the upside. Now, I've always liked the yen, and the yen, as I said before, they're starting to show their index is up over 16%. And their equities, based on the Bank of Japan Governor Ueda, when he expressed confidence that basically moderate inflation was likely to continue. That's what the investors want to hear as far as a stronger yen. All right, and that's gonna work itself off. And if we go look at the currencies back up here, with the yen, let me get back up here in the yen. Let's see, right over here. Here we go, right here. Right here. You can see with the yen, it's just moving a lot lower, and this is on a weekly chart, right? And you can see back over here, it's getting crushed. And I do like the yen to the upside, right? We're coming back down. It's probably going to find some support right around here and take off. Much like nat gas, we're getting to these levels where I like being long nat gas. I like being long the yen. Okay. And if we come back to a daily chart, you can see just how the yen has honored this regression channel right here, coming all the way back down, almost like a double bottom. Okay. We're not getting the divergence here that I would like to see. We're not lower than this yet, but I think taking longs in the yen makes sense to me. Okay. So that's just something that I like. And with the energy the way it is, especially nat gas, it's a very similar chart, right? I mean, it's come undone, and these gaps will eventually be filled. Okay, so when you get nat gas down at these levels, that's cheap, guys. And you can see the MACD. That does suggest it's probably going to run up and then roll back over, but short gains here, and then longer term, I think nat gas is going to be higher than where it is right now. All right, everybody, that's my update for the weekend, for our weekly roundup. Members, I'll see you Sunday evening for our weekly market watch. Everybody else, have a great weekend. And if you're interested, come on in and join us. We're having a great time. Good year. And last several years, we've just been knocking the ball out of the park. All right, everybody, have a great weekend. Members, I'll see you Sunday evening for our weekly market watch.